Hi, this is Tracey Velt. I'm filling in for Sarah Wheeler. I am the host of the Real Trending podcast and also head up the real estate content for the newsroom. Today, I'm speaking with HousingWire analyst Logan Mohtashami about inflation and interest rates.
Yes, and Sarah got sick of me. She's on vacation. She said, "Adam, I'm tired. I can't take forward podcasts with Logan while I'm vacationing."
Yeah, that's what
so
she told me
she
at
just ran
least.
off. So today we are going to talk about, because Mike Simonson asked this question on Twitter. I thought it was a good one. What happens to inventory in America if mortgage rates go below 6%? And he does these polls, and a lot of people, it's kind of all over the place. Half thought inventory goes down, half thought inventory goes up, and the other half said it'll stay the same. But it's so much of my economic work over the last 10 years plus. But it was very, very tricky during COVID, because what happened during COVID is, before COVID hit America, existing home sales kind of broke out to pre-cycle highs, and then inventory broke to all-time lows, and rates were below 4%. So it was like, oh boy, this is not a good thing. And then because of COVID, a lot of people just didn't think about it because they thought we're going to go into a depression. It doesn't really matter what inventory is doing. But, we wrote the recovery model on April 7th, 2020. We said game's on. But it created a very, very savagely unhealthy housing market. So it's a good time to kind of think about, what are we going to do now if rates go lower? Because, inventory, while it's not back to normal levels, it's good enough to take the savagely unhealthy housing market theme off.
So let's talk a little bit about the inflation. It's inflation week. So what is the Fed looking at for the next 6 months, and what are you expecting?
It is interesting because on Thursday morning, one of the Fed presidents said, well, we think inflation is going to finally hit in the June reports, which is, the 3 inflation reports in July will be for June. By the time this podcast comes out, one of the reports will be out there. The CPI inflation data, that data line is very tilted with shelter. So tariffs don't really impact that. And that thing has been moving lower and lower for some time now. So if we get a cooler inflation print because of shelter, the Fed's not going to really care about that. It's kind of the personal consumption expenditures, which that inflation report comes out toward the end of the month. And going out for the next 6 months, the Federal Reserve needs to justify their stance. They need to have inflation really start to perk up to 3%, at least 3%, to warrant holding rate cuts back. Of course, my take has always been the same. Without tariffs, they only would have cut twice. With tariffs, they would cut twice. If the labor market broke for some reason, then they can be more aggressive. But it will be interesting to see Fed statements after the CPI inflation report and the PPI inflation.
So I'm interested in the jobs report said that there is an increase in government jobs, but then the Supreme Court just said that Trump has the authority to let some of those people go. Have you seen any movement on that?
So federal workers have taken the brunt of the damage. State and local hirings was abnormally large in the last jobs report. In all honesty, if you take the government jobs and the healthcare jobs out of the equation, the labor reports look completely different. That's kind of been the big drivers for the last 13, 14 months. Now, what happens in state and local is very limited. You can't really do anything unless you withdraw money from the system. You got to hire teachers, you got to hire firemen, you got to hire police, stuff like that. But on the federal side, federal jobless claims already took a really, really huge spike. I like to show those charts because we never really cared about them until recently. And now they've kind of come down. I know Marco Rubio is going to be announcing layoffs in the State Department, stuff like that. But that's still a small sliver of the over 162 million people still working. And again, the labor market has been getting softer for 18 to 24 months in terms of private payrolls, but it hasn't broken yet. So it becomes a little bit more interesting going out for the next 6 months as well. Is does the private sector pick up? Does it stay kind of flat at very low levels, or does the private sector data start to get softer? Because if it gets softer and the Fed's inflation doesn't pick up, they get trapped in kind of a box out there for that.
So I want to go back to the inventory question, and what do you think will happen if rates go under 6%?
So when we look at the history of housing data in the 1980s, 90s, and 2000, what traditionally used to happen is home sales rise, prices rise, and sales rise together. This is, we call it crayon economics. I draw these black lines to show that's what inventory and sales and prices used to do. And then after 2010, qualified mortgage came in. And what that means is that everyone's legit. If you're filling out an application and you're ready to buy a house, you're a legit home buyer. Then what happened is the millennials came. And I always say that everyone likes to blame BlackRock, even though BlackRock owns zero homes. The millennials were the biggest home buyers in the world. And those pesky kids do not give you a house. Since 70 to 80% of sellers or buyers, they at least give you a property, the baby boomers and Gen X, but the millennials for a long time, they just buy a house and take it away. So what occurred was inventory slowly was moving lower and lower and lower for years, because in that kind of makeshift model, you could understand if the first-time home buyer is still buying homes, that just slowly withdraws the inventory. However, what happened in COVID, all hell broke loose. Inventory got to all-time lows. We had too many people chasing too few homes. So part of being team higher rates in February of 2021 is like the only mechanism we have for inventory to grow is to suppress mortgage demand so inventory can breathe itself up. It's not like new listings data has been taking off in any big fashion. The last 5 years have been the lowest ever, but you slow sales down and inventory can breathe itself. But now the question is, hypothetical, let's say the labor market breaks, mortgage rates go down to below 6%. Does that really change the inventory curve? And what I would say is that what we have seen after 2022 is whenever rates do get down to 6%, it slows the growth rate of inventory. I think early 2023 was a really good example. Mortgage rates went all the way down to 6%. We had one big home sales print. Inventory grew very slowly, but rates went back up to 8%. Inventory is able to grow. The last 2 years, inventory has been able to grow. What we don't have to worry about, what I don't believe we have to worry about, is if mortgage rates get to, let's say, just 5 to 6% range. I don't believe we need to worry about the mass inventory push lower. Affordability is still an issue. We will get a little bit more demand, but it's not like existing home sales are trending at 6 million. We are far from that level. I think it'll look a lot different than what people were accustomed to in the past. And this is probably my wishful thinking. I don't want the last decade. I want the 80s, 90s, and 2000 back. The music was great back then. My hair was even good back then. I had curls even at one point. Back then, you get rising sales, rising inventory, rising prices, but the price growth stays very, very tame. The housing bubble years was very unique. That was a very big credit boom, credit bust. But what we saw in the 80s and 90s would be very, very acceptable. So I'm hoping if that day comes, because it's really hard for me to even forecast below 6% mortgage rates unless a bunch of things happen. But if that comes, I don't believe we have to be afraid of inventory just collapsing or just heading back down to the lows that we saw in late 2020, 2021, or 2022. We will see a pickup in demand, but the buyer-seller profile should look a lot different with mortgage rates at 5 to 7% than mortgage rates from 3 to 4%, because home sales are still significantly depressed. If I thought home sales could get back up to 6 million or anything like that in any short time, that's a whole different equation. But I just don't see that kind of demand bursting up higher. We'll get some pent-up demand because there's people who've been waiting for many, many years. But I think it'll be a much more healthier aspect than what we saw during COVID, where just people forget in 2020, inventory just collapsed. We never had any seasonal increase. That was terrible. Like at the end of 2020, I was like, oh no, this is really, really bad. I remember going on Bloomberg Financial the first 2-3 months of 2021, and people were worried about forbearance. I was like, no, does anybody know how low inventory is? It doesn't matter. Even if demand is stable, you still have too many people chasing too few homes. So we are in a much healthy spot. We are no longer in the savagely unhealthy housing market. We're no longer in the unhealthy housing where inventory is able to grow. And we have so much of a cushion now. And it's not like rates are down at 3%. We have enough to keep that supply and demand equilibrium working in a very healthy fashion. And we're like we have one more week for the tracker to filter the July the 4th data out. And it'll be interesting looking out for the rest of the year until we hit the winter holidays. How does the data look hypothetically, if rates fall down even just towards 6%?
That's great. So what are you looking for? What are the key things that you're looking for in the tracker for the rest of the year?
So before July the 4th holiday came, I saw a stabilization. I saw a 2-week stabilization in the data, and mortgage rates got down to like 6.75, around there. So some stabilization. Purchase application data has been picking up the last few weeks. What I'd like to see is, do we get something of a repeat of last year? Now, do we need mortgage rates to get down to 6% to kind of have the repeat of last year, or is 6.75 good enough in 2025? So does inventory accelerate like it has in the previous few years toward the end of the year? Does new listings data, it's going to have its seasonal decline, but do we see a little bit more aggressive seasonal decline? Does the price cut percentage just basically flatten out until the seasonal decline? What happened last year is when mortgage rates got down to 6%, the purchase application data started to get better. Nobody cared about it because there was no year-over-year growth. But the forward-looking data got better. Our pending weekly sales, our weekly pending sales and our total pending sales started to deviate from the trend. And we're like, whoa, it's going to take a few months for this to hit the existing home sales market. So things are changing. I lost my price forecast because of that. I knew in September and October, I said, I'm cooked. I'm going to be too low this year. So that's what I'm looking for the second half of the year, because this year looks totally different because purchase apps are up, sales are no longer declining, but we don't have like the pending home sales data showing any kind of real growth. So we're getting an existing home sales report soon. I don't think it's going to be anything spectacular, roughly kind of in a flat sales trends, but going out for the rest of the year, that's what I'm keeping an eye on, because I had a lower price forecast this year than I did last year. I have back-to-back negative real home prices. So I need to be really aware if the data, it goes against me, I need to get that target and say, okay, I lost it here, explain it to everyone. And that's how you explain kind of the supply and demand economics, how our live, fresh weekly data, so people can see, does this shift the marketplace? Does this not shift the market? Or does lower rates bring out more sellers than usual? I don't believe in that theory, but it becomes a little bit more exciting in the second half of the year if mortgage rates just get down to 6.25, something around in that level.
Great. Well, Logan, it is always a pleasure talking to you. Thanks so much.
My pleasure.